This week, here's what's keeping Treasury rates and reverse mortgage expected rates stubbornly high. More after this short message.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Okay, home prices are still near their post-pandemic highs, amazingly. And despite 3 interest rate cuts by the Federal Reserve, long-term interest rates for traditional mortgages and home equity conversion mortgages, for that matter, they remain elevated. So the question is, what gives? What is the source of this strange economic limbo in which we find ourselves? We'll jump into that topic in a moment, but before we do, if you do enjoy this channel and find value in our content, consider subscribing and liking our videos, which helps us get our message out to more mortgage professionals like yourself. Thank you in advance. So, what is keeping interest rates up for traditional 30-year loans and the home equity conversion mortgage? And that's the 10-year constant maturity Treasury rate. Well, in one word, it's inflation. One of the key indices for inflation is the core PCE, or Personal Consumption Expenditures Index. The PCE index measures core inflation, but excludes volatile food and energy prices. It's one that the Fed watches closely. In January 2021, the core PCE index was 1.7%. By January 2022, the index had shot up to a high of 5.4%. Now, ironically, during this time, Treasury Secretary Janet Yellen repeatedly assured Americans that inflation was transitory due to temporary factors such as supply chain disruptions and pent-up consumer demand following the pandemic lockdowns. And perhaps that part was transitory, but what she failed to mention was the impact of trillions, yes, trillions of dollars in spending. Consider this. According to NASDAQ, as of March 2021, COVID costs totaled $5.2 trillion. Then you add $4.5 trillion for quantitative easing, or increasing the money supply, and another $3 trillion for infrastructure. And those numbers are just up to 2021. And with 80% of the money in circulation being printed between 2020 and 2022, it should come as no surprise that inflation remains persistent, not transitory, although mercifully below its peak in June of 2022. There's more dollars chasing the same amount of goods and services. Consequently, bond traders and investors are demanding a higher rate of return on their investment when it comes to treasuries and in an uncertain inflationary environment. And really, who can blame them? They consider that their return on their investment will be worth less in the future. And why shouldn't they? After signaling up to 4 potential rate cuts in 2025, the Fed now projects only 2 rate cuts this year, thanks to higher inflation readings in recent months. And the markets are showing this. Now, current economic conditions are one factor that investors weigh, but it's also long-term expectations that come into play. And speaking of expectations, in its January 2024 housing forecast, Fannie Mae predicted that mortgage rates would fall to 5.8% by the end of 2024. However, while the rates did fall briefly under 6% for 30-year mortgages this fall, they quickly shot up to an average of 6.8%. During the same time period, the 10-year constant maturity Treasury rate that is used for home equity conversion mortgages came in at 3.65% in mid-September and now sits at approximately 4.5%, nearly a 1 basis point increase. The future of HECM and traditional mortgage rates is going to depend on our nation's economic performance, growth, and debt management. President-elect Donald Trump has outlined several very aggressive strategies which he says will combat inflation, and part of those include increased energy production and reduced energy cost, lower federal income taxes, restrictive tariffs, massive regulatory cutbacks, and perhaps most notably as of late, government spending, which is the focus of DOGE. Now, projections for the 10-year U.S. Treasury vary widely, with T. Rowe Price anticipating yields could climb to 5% in 2025. Morgan Stanley is a bit more sanguine, expecting yields as low as 3.75% by mid-2025 and as low as 3.5% by the end of the year. 2025 could be a year of economic limbo, leaving investors and homebuyers in a holding pattern. A clearer path forward will need to come into sight before expansion and investor optimism can help to push these long-term interest rates down. Now, what are your thoughts? Leave your comments in the comments section below. And if you'd be so kind as to share this week's video, you can do that on your LinkedIn network. And as I mentioned earlier, we have a YouTube channel, so if you haven't hit that subscribe button, go to our YouTube channel and you can do that now. And each and every week, we bring you the latest reverse mortgage news that's curated for you as a mortgage professional. That's HECM World Weekly. We have both an audio and a video version of that podcast. Thank you so much for joining us. Have a great week, and be sure to return next Monday for more reverse mortgage news, commentary, and analysis you'll only find here at HECM World. Make it a great week.